Welcome to Sectors Up Close. I'm Elena Casas. Today we're looking at the oil sector and my guest is Russ Mould, Investment Director at AJ Bell. Oil prices have been creeping higher over the last week, reaching their highest in more than half a year as Brent crude edges up towards $90 a barrel. Russia is expected to announce new oil export cuts this week, with Saudi Arabia also expected to roll over a voluntary 1 million barrel per day cut into October. OPEC Plus has been cutting output since April, with initially limited impact on prices, as oil traders seem to conclude a global recession hitting demand was more likely than a lack of supply. But were they right? Let's ask Russ Mould, Investment Director at AJ Bell. Russ, hi, thanks for coming in.
Pleasure.
So, has OPEC Plus's strategy worked out for it then?
So far, the price increases that we've seen since June, oil up by nearly a quarter, would suggest so. And it's unusual for OPEC Plus to stick to its production disciplines. But the Russians, as you say, may be coming with more cuts. The Saudis are sticking to the script, and none of the other smaller members seem to be changing their position either. So at the moment, from the supply side of things, yes, OPEC is getting where it wants things to go.
We're seeing that Russia is still able to move the global price with cuts, despite Western policies which are supposed to cap how much the Russian state can earn from oil. Does that mean the cap simply isn't working?
To a degree, it also means that Russia still has willing customers. China and India, for example, have been trading quite freely and will probably continue to do so.
And what about US demand in all of this? We know that the Strategic Petroleum Reserve is at its lowest for decades. Is the attempt to fill it up going to start pushing the price?
Well, it hasn't yet. I mean, the reduction in the American Strategic Petroleum Reserve ahead of the midterm elections did seem to have some impact. So it would be logical to expect when the Americans look to refill, that it will potentially provide a demand side kicker and maybe drive the oil price higher. So that's a distinct possibility, yes. So at the moment, overall, global demand has been holding up better than expected because recession fears haven't been fulfilled and haven't led to any decline in oil demand. If anything, oil demand forecasts have been creeping up during this year.
Do you think then that those recession concerns are now off the table?
It's a really good... the equity market seems to think so as well. So equity markets and oil markets on the same page, no longer pricing in a hard landing, no longer pricing in a soft landing, pricing in further economic growth down the line, certainly in the West, yes.
From the point of view of the oil majors then, they did book considerable profits last quarter, not nearly as high, of course, as the year before when we saw that big spike on the start of the war in Ukraine. But they obviously feel confident about their earnings going forward. They've launched major buybacks, both Shell and BP, and they've raised their dividend. So what do you make of that strategy?
Their long-term price assumptions are, $50, $60 a barrel? So if you're ticking along at 80 to 90 quite happily, and that feels well underpinned right now, they're going to be generating plenty of cash, more than enough to keep the taxman happy and fend off any windfall taxes, keep investors happy with dividends and buybacks, and keep investing in their core assets, where they now no longer seem to be planning for a decline in production, but BP and Shell may be flat out to 2030, and alternative investments in renewables and future sources of energy. So at the moment, they're in quite a good place, yes.
Do you think investors should be concerned, though, about political pressure on them, both over prices at the pump and the environmental question, that could lead to higher taxes?
We have a general election in the UK next year, a presidential election in the US next year, so politicians will be watching, particularly if prices at the pump on the gas station forecourt start to go up again. We've seen a sharp rise in the UK in August, so that will be an issue. And that could then feed through to inflation, which will be a political hot-button topic for 2024 as well as an economic one. So a further acceleration in oil towards, say, heaven forbid, $100 a barrel, it may come on the agenda again, though we've already seen windfall taxes in a lot of European countries as it is.
Given the pressure to reduce emissions and the fact that the investment being made by the majors in renewable energy is still quite limited, yes, do you think that investors should be moving their money into different kinds of energy companies? Is this really a good time to buy oil majors? I think that depends upon the
to a degree, ethical principles of the investors. Some will just say, no, I'm just not interested because I view this as a bad thing from a carbon perspective and a net zero perspective. Some investors might just be really hard-nosed and just focus on the dollars and dimes, nickels and cents that are coming in from higher oil prices and dividends and buybacks. So a lot of that will be down to individual investors' personal preferences. And from an economic perspective, at the moment, the oil majors are making lots of money. And we've seen in the renewable sector, unless there are lots of subsidies sloshing around, it can actually be quite hard to make an economic return. And that's one reason why the oil majors have perhaps, dare I say, refined their capital investment strategy and perhaps gone back to focusing a little bit more on hydrocarbons more than environmental campaigners would certainly like.
Their valuations have picked up over the last couple of years. Are we going to see those move higher, do you think?
If oil keeps on moving higher, that will certainly help to underpin them. And I think, you've seen a big scramble from oil traders to cover oil shorts because they're expecting that recession. That hasn't happened. I don't feel as if the oil stocks are overloved by any means. Ethical reasons, lots of investors saying no. But from an earnings perspective, yield perspective, they're not especially expensive right now, no.
Russ Mould, Investment Director at AJ Bell, thanks so much for joining us. And that's your roundup of the oil sector. I'm Elena Casas, and this is Reuters.